and of course, which is the overall corporate governance, the fit and proper, the understanding of the Sharia scholars themselves, and that vis-a-vis the young industry that is evolving, and Sharia being more and more experienced, getting to that experience level and sophistication level where they could understand and realize how how things could be structured in an Islamic way.
Thank you very much. Dr. Stein.
Sorry, yeah, we are running out of time, and we spoke about that integration, but I didn't want the word for myself, but we have a splendid sheikh here. Perhaps he... Oh, sorry. Okay, but if Sheikh Bilal has remarks to that, I think this would be the other side.
Please.
I think if we are running out of time, I just wanted to introduce something here, because I see that there's a wonderful attendance from Africa. I'm a chairman of a microinsurance committee of an association called Actuaries Without Borders, which is part of the International Actuarial Association. This body is like a charity organization, and right now we are actually sort of trying to sort of connect in Africa. We have a project coming up in Kenya. It's about actuaries going into that country, for example, with the regulator and insurance companies, and trying to sort of bring what is needed in the insurance industry from the actuarial profession's point of view. This project is almost there for Kenya. We are working on that part. There's also, we can do a lot on the micro insurance. And of course, wherever there's Takaful, we can do that on micro Takaful. What we can do is if you have people in your companies who want to learn or understand and maybe do some products by themselves, then we, through International Labor Organization and other organizations, can actually put them through courses, training courses, so they can learn about these things and go back to your markets and countries and try to put these things in there from your own base, your own insurance base or Takaful base. So if you're interested, please look up the website for Actuaries Without Borders or contact me for that.
Thank you very much. Please.
This is Turkey from Wuqaya Takaful Insurance and Reinsurance Company from Saudi Arabia. This is for Munich Re. We noticed Munich Re getting involved or focusing in Takaful insurance. Do they have any strategy to market this concept in Europe market?
Yeah, we get the requests all the time. We have a direct company, as you know. They postponed that. So we would offer our knowledge as a reinsurer and our experience with the direct markets in the Middle East, in Malaysia, partly in Pakistan, to companies in Europe who want to produce that. Knowing one thing, in my deep conviction, for the time being, the market will not sustain a standalone Takaful company in Europe. You have to work on a sort of window or shared service cooperation basis. But, of course, we have 20 million Muslims. Russia is an interesting market. Tatarstan raised interest. We would be pleased to support this, because supporting the customers with knowledge, whether Sharia or conventional, is our business model.
Thank you. Ladies and gentlemen, we have learned panelists here, a wonderful participative audience there, and a wonderful discussion going on, but we'll have to wind it up. We'll all be available during the lunch or maybe later on, so we can have the question answers later as well. With this, on behalf of the panel, I would like to thank you all for your participation and the organizers for giving us this wonderful opportunity. Thank you very much. Thank you all. Assalamu alaikum.
Would you like to have a 2 minutes break I can give before this? Otherwise, we are running short of time, and the next presentation, which is going to come, I can see that's a very interesting topic here, which is how can solid risk management and sustainable insurance help attract finance? This is coming from Mr. Yusuf. And let me give a little bit short synopsis of Mr. Yusuf. I'll just give a little bit of rundown of the next presenter, Mr. Yusuf. And Mr. Yusuf Dereza Kenyanda, he is the Senior Insurance Officer from International Finance Corporation from Zimbabwe, a Zimbabwean national with more than 25 years of risk management and insurance experience. He started his career as an insurance broker of Marsh, Willis, and Aon, and he has moved into risk management at De Beers Group of Mines in Southern Africa before joining International Finance Corporation, based in Washington, the World Bank's private sector arm, where he is currently providing support in risk management insurance for IFC projects in various regions globally. Sector experience includes infrastructure, manufacturing, services, agribusiness, jets in various regions globally, and mining and financial market. Yusuf is a graduate of Luton University and a fellow of Insurance Institute of South Africa. He is also a member of Institute of Risk Management UK and Risk Management Society US. Ladies and gentlemen, give a warm welcome to Mr. Yusuf for a wonderful topic here. Mr. Yusuf, please.
Thank you, Mr. Chairman. Good afternoon. Should I say good morning or good afternoon? It seems risk management is a key topic which has been mentioned a couple of times by the panelists and everybody else from yesterday and today. If I can give you a brief background, risk management is not all about reducing or eliminating losses. It's about maximizing opportunity while minimizing the downside. I'll share with you a couple of examples later on how at IFC we are trying to manage risks on our projects throughout the globe, and also how lenders and financiers look at risks in project finance and how they should be mitigated and also managed. The investors, as you know, they are most worried about the money that they put into projects, their equity into projects, whether it's going to result in sustainability or whether they're going to receive their return on the monies that they've invested. This is just a brief introduction, briefly introduce you on IFC, how it fits into the World Bank Group, and also take you through the reflection of 2011 events that happened. The world is getting riskier, as we know, and also explain how risk management is making an impact in project finance, and give you examples of some risk solutions being envisaged by investors and financiers and the projects themselves, and how the role of insurance is playing in the risk management process. So let's just look at the whole picture of the whole World Bank Group. We have IBRD, which is the International Bank for Reconstruction and Development, IDA, International Development Agency. Then we have IFC, which mainly works with the private sector. And we have MIGA. I think there was a speech yesterday by somebody from MIGA, which is our sister organization. I'm sure he must have explained the role of the World Bank Group, so I do not want to repeat this. I'll focus on IFC. IFC mainly involves itself with the private sector, providing short-term, long-term loans, guarantees, risk management products, advisory services, and it takes market risks. It's unlike the World Bank Group, which takes the macro risks. IFC actually takes market risks, just like any institutional investor in the respective countries. There's no political risk guarantee on IFC project. So any losses or any effects in the company or in the organization can affect IFC's investment. IFC has invested in 102 companies last year, spending more than 19 billion. And of that 19 billion, 12 billion has been of its own account and mobilized an extra 6 billion from other financial institutions to provide finance to these loans. And IFC has recently created a subsidiary called Asset Management Company, which co-invests with IFC in the emerging markets. And also, it uses third-party finance monies from other, it might be private wealth funds, government wealth funds, which is lying idle there. Then they mobilize this fund and they invest into emerging markets and developing countries, together with IFC or independently, but as a subsidiary of IFC. So let's reflect to the events that happened. I'll briefly show you a video which was shown in Bournemouth at a conference of AMIC, which is the Risk Management Association in UK. I sought permission from AMIC to show this video, so they are aware that I'm showing this video here.
Japanese firms and households ground to a halt, washing away cars and businesses.
The exclusion zone has been extended from 3 kilometres to 10.
Heathrow has closed completely.
Commuters have been forced to stay home, hitting firms already suffering from the credit crunch.
A shopping center is leveled, they're just gone.
Similar to what you might have seen in a war zone.
Its second worst day of flooding on record.
19 metres above their normal level.
Several shipping companies have decided that their vessels should take alternative routes.
Egypt itself is gripped by labour strikes.
The opposition will be looking for concrete gestures to show that Egypt has not just moved from one dictatorship to another.
Thank you. This just goes to show that the world is getting riskier, and risk management will play an important role globally as we investors seek to get adequate returns for their monies in the projects that they do invest. So let's just reflect on one major event that happened in Japan and affected some companies globally. This resulted in losses of more than $235 billion, and also with the loss of lives. And when you look at some of the events that have happened, for example, in Haiti 2 years ago, there was an earthquake that killed more than 200,000 people. At the same year, last year, we had an earthquake of 7 magnitude scale, which killed more than 16,000 people. From a risk perspective, let's just compare the two scenarios. In Haiti, 7 magnitude earthquake, killing 200,000 people. In Japan and Turkey and New Zealand, similar size, but killing 16,000 people. So how can risk management play when you consider in these two scenarios? So natural hazards such as floods, windstorms, drought, wildfires, and other extreme events in different countries leave investors and financiers thinking about how can their projects be protected. Will they get their return on their investments? What are these companies doing to manage these risks and protect the investors' money, and also retain and maintain confidence? Globalization has brought its own risks in terms of supply chain. Consider a European car manufacturer which is outsourcing spare parts or components in, say, in Tunisia. What is the impact? How are they managing these risks from these companies that are part of this global supply chain?